Hello and welcome. You're watching The Money Show, your one-stop destination for all your personal finance queries. I'm Kavita Thapalial, and today again we have lined up a very exciting show for you. In the first part of the show, we'll be speaking to Trideep Bhattacharya from Edelweiss, and in Meet Your Fund Manager segment, we're talking about the market trajectory, and also we're focusing on mid-cap and small-cap funds. And further up in the show, we'll be doing your live financial planning. So just in case you're watching the show live and want to send across your financial portfolio details, you can do that on our WhatsApp number, which is 865-7974-571. We also have an email ID, themoneyshow@etnow.tv, where you can send across your queries. So let's begin and let's talk about today's market. Nifty closed below 22,120 today, extending its losing streak on to 9 consecutive sessions, its longest daily losing stretch since 2019. Now, amid persistent global trade concerns that weighed on the investor sentiment, the Sensex shed over 100 points. The market capitalization of all listed companies on the BSE decreased by almost 58,868 crores to rupees 384 lakh crore now. We talk about certain data that we have received. Nifty 50's trailing 12-month price to earning ratio has dropped below 20 for the first time since July 2022, marking a crucial shift in market valuations. Now, this sharp decline comes amid an aggressive FII sell-off, with outflows totaling to almost $13 billion in 2025 alone. Over the last 5 years, the Nifty PE has dipped below the 20 level only twice. First, in the aftermath of Russia-Ukraine war, when it fell to 18.92 between May and July 2022. And now, as the global uncertainty continues to rattle the markets, we've also seen that the index has recorded its steepest valuation through, at 17.5 on March 23rd, 2020, when the pandemic-induced panic triggered a 13% crash in a single session. This is what we are getting from the NSE data. Now, the question is, despite the valuation correction, opinion remains divided on whether Indian markets now present an attractive buying opportunity. Let's discuss more on this. I have with me Trideep Bhattacharya, President and CIO Equities, Edelweiss Mutual Fund. Trideep, good evening and welcome to the show. A crucial interaction session today because we want you to handhold our viewers and help them understand how to look at this particular market fall. What, according to you, should be the way ahead for an investor who's invested in last 2-3 years, and also for an investor who's invested for almost more than a decade? How do you look at this fall? Is it a correction that we guys were already waiting and talking about?
Sure. So thanks, Kavita, for having me on your show. I would say if you look at the last year and put that in context, this correction that we are seeing is a bit different from the shallow corrections that we have seen over the last 3 years. It's different in the sense that this correction has been accompanied by earnings downgrades. For the first time in the last 3-4 years, driven by probably lack of decision making because it was election year last year and also weather was not particularly great, we saw an earnings cut of close to about 10 to 12% over the last 9 months, so to speak, of this fiscal year 25. And hence, if you look at the broader markets, Nifty has corrected roughly about 16% from the peak. But broadly speaking, during the course of FY25, it has corrected somewhere around 12 to 15% across indices. So in many ways, the market correction has been in sync with the earnings downgrade that we have seen so far. And here lies the answer as to how the markets will do going forward. My sense is for the markets to bottom out, it first has to gain confidence that earnings have bottomed out. In my opinion, earnings will bottom out in a couple of quarters from now, probably in the back half of fiscal year 26. And the confidence on this is kind of, coming from 2 factors. One, that last year, government capex was actually 20 to 25% short of what was budgeted for, driven by indecision due to elections and whatnot. This year, that is expected to come back. This year, i.e. FY26. Secondly, this 1 lakh crore consumption boost that has been given by Finance Minister hopefully will bring about some cheer in the consumer or in the consumption basket as we get towards the back of this year. So both of these will ideally come about in the back half of this year. And hence, from here till the time we get there, maybe in the next 3-4 months, we could face a little bit of volatility. But it is a helpful volatility to kind of, gradually pick the stocks, to gradually get the portfolio in order if historically we have missed out. And hence, for a long-term investor, this is a perfect hunting ground to gradually start hunting for stocks, because finally, as you pointed out, the large cap valuations are roughly about 5% lower than 10-year average, and mid and small cap valuations are roughly about 10 to 15% premium to 10-year average. It's still at a premium, but the premium has come down materially over the last 9 months or so. So those would be some assessment of market, Kavita.
I also want you to help our viewers understand the concept of price correction and time correction. Now, the mid cap and small cap, you said, there's hardly any froth left. But what about time correction now? Whatever pockets where you're seeing valuation is still very expensive, are we looking at time correction over there?
Yeah. So I think the difference between price correction and time correction is generally, the price correction happens very quickly when there is earnings downgrade. So to a certain extent, we have seen that. The next few months where maybe we have 75% of the earnings downgrades are behind us, roughly about 20-25% of the overall earnings downgrade is kind of in front of us, which will happen over the next a quarter or so. Since majority of the earnings downgrade has been done, maybe we could see a bit of time correction over the next a quarter or so as the prices digest the current level of earnings. The main thing that the market is looking out right now is confidence that the earnings have bottomed out. The last result season, which is Q3, didn't provide so. I don't think Q3 or Q4 will have the answer as well. I think starting from Q1 and mostly towards Q2 onwards, Q2 of next financial year, that's when we will get the confidence in the earnings, and that's when the time correction is expected to end as well.
Talk about the sectors that you are interested or you are looking at specifically in your mid cap and small cap fund.
Sure. So I think, what the market has done so far, looking at it in another way, it has separated out the beta from the alpha, in the sense that last year, a lot of beta trades, which included the narrative stocks, the stock which were at the right place at the right time, went up irrespective of whether the inherent business model is strong or weak. I think this correction has brought down some of the share prices to where they probably should be. But in the way of doing that, it has also kind of taken the stocks with strong business model, with strong earnings prospects over the medium term down as well, because the market doesn't treat differently in the near term. And that's where the opportunity lies. So in that context, if I were to point you to three sectors where I think one is finding interesting opportunities for the medium term, I would probably point you to consumer discretionary as a sector, where we think that some of the stocks valuations are reasonable, and we expect over the next 2 to 3 years consumption to gradually bottom out and do well. Secondly, I would point out IT services, where overall on the as a second derivative trade on US economy doing well, currency depreciation, and also earnings bottom out, that could see a few good years ahead of us. And third, I would point you to NBFCs, which is non-banking financial companies, where driven by the rate cuts and reasonable valuations, we think that could be a fertile hunting ground for good stocks to hold over the medium term. So these three sectors is what I would point you to in the context of mid and small caps as well.
So talking about your mid cap and small cap fund, and if I just want to focus more on small caps, because over there the valuations are still a concern. I mean, a lot of concern over there still. What is the structure of your small cap portfolio? How much of micro cap is a part of it, and how have you taken exposure in terms of sectors? Are these three sectors a heavy part of your small cap fund portfolio?
Indeed. I mean, as a category, over the last 6-7 months, we've been a little more careful towards the small cap as a sector, because we've been saying that maybe that segment has probably, as a segment, will probably have to digest the earnings with regards to where the share prices were. And broadly speaking, over the last 9 months, it has kind of played out that way. Still, if you look at it, these three sectors represent an important portion of the small cap. But the way we have controlled the risk in the context of small cap is limiting our exposure to micro caps. And if I may, I mean, of course, there's no strict definition of micro caps, but if we talk about stocks with market cap less than 3,000 crores, we would hardly have any stocks in that category in our portfolio. And that was one of the ways how we limited risk on the downside. And also having strong franchises, as I had highlighted earlier in the sectors that we talked about, is the way we have limited the risk in the context of the small cap versus the benchmark. Of course, the category has done what it has done. Our relative performance still holds up because of these factors driven by us over the last 6-9 months.
Talking about your mid cap and small cap fund, how much cash are you sitting on?
So we, as a matter of principle, don't sit on cash, Kavita. Our principle is that timing the market is very difficult to do, and through the cycle is detrimental overall. So we instead, what we do is through our stock selection, we reduce the risk in the portfolios by going a little more defensive or more aggressive depending on where we are on valuations or on the business cycle. And in that context, we have been, the sectors that IT, we went defense is probably one of the defensive sectors. Consumption would be seen as likewise. We went early into heavy into those sectors, which has helped us sort of outperform in markets which have been quite tough in recent times.
That will be all. Thank you so much, Trideep, for being on the show and helping our viewers understand the current market trajectory. Thank you so much for participating today. Thanks. All right, on that note, let's take a quick break, and post that, let's begin our viewers' live financial planning. I'll be joined by Shweta Jain, who will be answering your questions live on the show after this break.